This is Daybreak Asia. We're counting down to Asia's major market opens. And Paul, we're just ahead of the trade in Japan, South Korea. A lot of markets pointing to green across the board. We had strong moves in the US session overnight, but still there's that question mark over what happens in China next, given the fate of Evergrande.
Yeah, that was very interesting, the winding up of Evergrande yesterday. We'll wait and see just how much water that Hong Kong court decision holds in mainland China. But plenty of moving parts today. We've got an oil price that's moving. We've got an ASX close to a record. And we're on the eve of a Fed decision as well, Belle.
That's right. And then also data to note in this part of the world as well, because we had Japan, for instance, putting out its employment data just in the last half hour or so and telling us that the employment market was pretty tight toward the end of last year. So we saw the job to applicants ratio, for instance, coming in at 1.27, a little bit of a miss on estimates, but still showing us that there's a shortage of workers across sectors. The unemployment rate as well coming in at 2.4%. So that keeps the hopes for wage hikes very much in play, and also really plays into our thinking around what the BOJ is going to be doing next, because we know that they want to see sustained salary hikes in order to drive demand-driven inflation. That is one of the themes we're tracking in the session today. You do see the Nikkei here just posting some modest gains to start, following, as we said, US stocks, the S&P 500 crossing the 4,900 mark. One stock, though, that is moving to the downside so far is Toyota. That one just coming online. So the big news for Toyota overnight is that they're temporarily suspending shipments of 10 vehicle models. That's after a supplier to Toyota disclosed certification problems with some diesel engines. So just the problems for Toyota really do seem to be sort of piling up, and we are seeing that reaction there, down 1.3%. Let's shift now to what we're seeing in Korea at the start of trade here, and we have got some gains, quite strong ones, especially for the Kospi there. You can see up more than 1%, perhaps tech-driven. We did see, as I said, the S&P 500 crossing 4,900, but the Nasdaq as well up 1% ahead of results from the 5 tech giants: Alphabet, Apple, Amazon, Meta, Microsoft. All of these are reporting just in the days ahead. So really, Paul, a lot for investors to be focusing here on earnings, Fed decision, data, and also those borrowings from the US Treasury.
Yeah, here in Australia as well, plenty going on also. We've got the ASX right now knocking on the door of a record high. We're at 7,617 points at the moment, so we're just 15 points shy of the high. The ASX performing pretty well, better by 0.5%. It's information technology stocks that are also leading the charge here, and we did have a pretty good day for the Nasdaq as well. Keeping an eye on bonds today as well, we see the yield on the 10-year slipping. I'll get back to bonds in a moment. The Aussie dollar also breaking through that 66 cents level. And here we are. Take a look at the bond space, the early trading in Tokyo. We've got yields rising just a little, but we did see yields falling across the curve on the news that US Treasury estimates borrowing needs are quite a bit lower, $760 billion for January through to March. That's down $56 billion, and that did confound some of the expectations around that. So perhaps the short end of the curve looking a little bit vulnerable to more declining yields there. And of course, we're waiting on the Fed as well, just one day before we get that decision. No change expected, although we are keeping an eye on March as a date for possible movement. All right, we're joined now by Olivier Dacier, head of APAC Applied Research at Axioma. Olivier, a lot of news in the news flow at the moment, and you see 2024 as being the year of predicting dangerously. What sort of variables are you balancing?
Well, for the first time, economic variables or even corporate earnings are subordinate to geopolitics, right? You've got a lot of things going on in obviously Ukraine, obviously Hamas and Israel, also US-China tensions. You've got a presidential election in the US, also EU elections, the far right making friends with the agricultural lobby. So there's a lot of things going on that could potentially change the trajectory of some of the inputs into the traditional economic models we use to predict the economy going forward, even interest rates, oil prices. inflation and so on. So that is really where we are right now, where the forecasts we make have assumptions that could change 1 week to the next. And as we saw with oil prices over the weekend, right, we went up 6, 7, 8% just on the news that we saw the first 2 U.S. military casualties in the Middle East conflict. We've also heard that there will be a response. So everybody's waiting for that now, right? So things could change very rapidly during this year.
Yeah, there's some interesting upside risk to consider as well in terms of perhaps good news being good news again. We're, of course, on the cusp of a Fed decision. This recession risk really seems to be abating. We've got earnings looking pretty good. Consumer looks strong. Jobs look strong. Do you think the urgency around easing is perhaps abating a little for the Fed?
So the problem with good news being good news is that if you think about the good news for this year, it's the predictions of a soft landing, for example, in the U.S. economy. And if you do get a soft landing, you still maintain an inverted yield curve, which is, a little bit of a bad news for some of the bond investors. Nothing but a hard landing scenario will return the yield curve to an upward sloping curve anytime soon. So the longer we have good news, the longer the Fed feels it doesn't need to support the economy, and therefore it doesn't need to start cutting rates early. We have already seen that the expectations for the March FOMC meeting, which were like almost 90% they would cut, now it's back to 50-50. So we're back to not being sure at all that we will get a March rate cut in the US, right? Now it's pushed back to May.
The thinking, as you write in your note, seems to be that if the US can avoid a recession, then so can the rest of the developed world. But that's something that you disagree with.
It's something that has a lot of assumptions built into it, right? Europe is already teetering on the brink of recession. We saw Germany already have some negative numbers. The consumers in Europe are not the same as the consumers in the US. They're not spending, they're savers. And with interest rates where they are, more of them are saving than spending. So you're not getting that consumer boost to the economy in Europe. The ECB is going to have to start cutting rates. And even though the ECB was about 4 months behind the Fed in raising rates, it may be the first one to cut. And that's what everybody is looking for. We didn't get that last week, obviously. And Christine Lagarde is being very, very tight about when she would, entertain a cut. But that's what is needed in Europe, especially with the fiscal situation not being good at all, with the EU sending back the budget proposals from Germany, from France, from Italy, from Spain, and saying you have to cut back, you're over budget. So fiscal stimulus is not going to happen. You need to have monetary stimulus. So it's all up to the ECB right now for Europe.
And what do you think then about the outlook for China and how it can try and stimulate its own economy? Because we have seen perhaps the actions of policymakers or monetary side fairly limited and more push perhaps needed from the fiscal one.
That's right. This is the fourth time now in about 12 months that you have rumors of a big stimulus coming, and all we get is some regulatory ruling change, some crackdown on parts of the economy. We're not seeing the big bazooka stimulus that we used to see from China, that we saw, for example, in 2015 when you had the China crash. And people keep waiting for that. And sentiment has really turned sour now in China, because fourth time now they got burned believing something was coming and something isn't. All we get is we're going to stop short selling. So as of Monday, it's becoming much harder to borrow certain stocks to short the Chinese markets. And these are, really not the kinds of measures that the investors were looking for. So you're still going to see a lot of outflows out of China, which is benefiting Japan and Korea. That's why these markets are doing well. Although, you could argue that globally, for the last 2 years, we've only had one bet, which was the tech sector. If you didn't have that, if you didn't overweight that, you underperformed, period. There was no other bets to make. And that's still going on right now. It's still all about the big tech and all about this move, this shift of the global supply chain away from China and into other areas, just in case.
And I think playing into that tech theme, it was one of the big drivers of US markets over the course of last year. We just had the S&P 500 hitting a record overnight, the NASDAQ as well, and this is ahead of the tech earnings. So is that something that you expect to continue over the course of this year?
So it's obviously a very big week, right? We have 5 of the Magnificent Sevens reporting this week. And valuations are stretched already. They're above the long-term average. They're above the median that they've been in the last 10 years. So where do you go from here? You're going to need some stellar earnings to really push the market up from here. And again, it's only one sector, right? We thought that from November, December, we thought the rally would broaden into other sectors because we had the soft landing scenario. But it really contracted back in January this month, where uncertainty is back and people are making forecasts and they're saying, you know what, these forecasts are 50-50, and you can't really broaden your horizon with just a 50-50 forecast. And I think it's still about the big tech. It's still going to be that way until the Fed says, okay, we're starting the easing cycle, we're starting the cutting cycle, let's go.
Olivier, before we let you go, I just want to get your views on everybody's favourite market at the moment, being the Nikkei. We've seen a lot of upside, and even within that, we've seen banks outperforming the broader index in Japan as well. Do you see more to come for Japan's financials, or as the BOJ lifts rates, or has all of this already been priced in?
I think, financials in Japan suffered a lot under the negative interest rates regime that started, way back in 2016. So they're getting, less pressure on margins from having positive interest rates, and I think that'll continue. The problem is not really the interest rate story is one part of it. The other one is the economy, and the economy in Japan is strong, and the BOJ still wants the economy to be stronger via consumer-led inflation. So, all of that is good for banks in terms of as a proxy to the economy in Japan. It's secondary to the tech sector and to the China relocation and supply chain issue, but it's still a positive for Japan. So Nikkei is still enjoying that. Plus the yen is still weak, around 48. So it's still okay.
All right, Olivier Dacier, Head of APAC Applied Research at Axioma. Thanks so much for your time this morning. And let's get a quick check on how markets are faring so far, because we're just over 10 minutes into the session. And the showing is fairly positive across the board, really. We are tracking the gains so far that we're seeing in the Nikkei, the Kospi, both of those moving high. So it is perhaps that tech story, that tech theme playing into it. As we were just discussing there with Olivier, we're still seeing those gains in big tech ahead of key earnings over the course of this week. The ASX 200, likewise in positive territory, and we are very, very, very close to a fresh record high for the Aussie benchmark. 7632, that is the level to track, 7,632 points. We will see if we can close above that to end the day. Kiwi stocks still the notable laggards in the region, but broadly, as I said, a positivity across the screen. The question is how that moves throughout the session as well, given that futures for Hong Kong and China pointing to a little bit of weakness. And playing into that, of course, has been the theme around Evergrande. And coming up, investors watching whether mainland courts will follow a Hong Kong order to liquidate the assets of that Chinese property giant. We'll preview the possible scenarios next. This is Bloomberg. You're watching Daybreak Asia. Now that a Hong Kong court has ordered the liquidation of embattled property developer Evergrande, the big question is whether that decision will be followed in China, where the bulk of its assets are located. So let's get more on that now and bring in our Chief North Asia correspondent, Stephen Engels. So just talk us through where we stand at this point in time.
Now it gets interesting, I think. I think Evergrande was heading towards this sort of foregone conclusion that there would be a liquidation. Sure, there was debt restructuring talks and this and that. It came to a head yesterday, obviously, when the Hong Kong court ordered the liquidation. They've hired Alvarez and Marcel to be the liquidator. But the big questions remain, will that order be recognized and implemented on the mainland? Sure, the bonds and the stock traded in Hong Kong, but the bulk of the assets, $248 billion worth of assets, probably going to get a fire sale price on that if they are actually liquidated in China. And there's so many variables here, because this is a company that has $333 billion in liabilities. The assets don't match that. Someone's going to be left short, obviously, but we really don't know, with the Communist Party essentially running the courts in China, whether they're going to, basically follow the Hong Kong order. There's no precedence for this, essentially. Back in 2009, North Star Auto, a similar thing happened on a much smaller scale. The courts in China did not follow the Hong Kong unwinding order, essentially. There's a few other examples. HNA Group, the Hainan Airlines parent, took 4 years to go through a bankruptcy process. It wasn't necessarily the kind of liquidation that the Hong Kong court ordered yesterday. It was more of an open disposal kind of process where debt restructuring went on while the bankruptcy process, the airline operated and all the different spaghetti bowl of affiliates operated throughout that process. But it took 4 years. It's a long, long process. And then there's also He Lifeng, who's the economic czar in China. We're getting lines, essentially, he is out telling the municipalities across China, follow the central government's policies on stabilizing and the clear financing to property firms with good financial standing. Follow the directives from the central government. Do not allow the disposal of all these pre-sales, the funds that are in escrow, essentially. See, what happens when something like this happens, there could be raiding of the cookie jar. Right? People are going to start grabbing what kind of cash and assets that they possibly can. And that's what the central government definitely wants to avoid. And the last point I'll make is when I talked about that discrepancy between the assets on the mainland and also the liabilities on the mainland, the central government wants social order. They want the uncompleted buildings to be completed and the units to be delivered to those who paid those pre-sales. But are they going to be top of the food chain as far as being paid? There's so many questions to be answered.
Yeah, so big, messy, complicated, a lot of competing interests. Yep. How long is this going to take?
Yep. You just said it. It's going to be messy. It's going to be long. It's going to be competing interests. Again, what's going to happen to Evergrande New Energy Vehicle, the affiliate? What's going to happen to Property Services? There's a whole, as I keep on saying, a spaghetti bowl of different competing units. There's going to be an unwinding and trying to figure out where certain funds are and who gets them, obviously. Will foreign or dollar bond holders, who are oftentimes overseas, will they get the short end of the stick, obviously? So I can't tell you how long this is going to take. Just precedent says it takes a long time. HNA took about 4 years. This could be a long, drawn-out process. We'll be talking about this. As I said to Annabelle earlier, this is when it really starts getting interesting.
All right, Bloomberg's Chief North Asia correspondent Stephen Engel there. And we're going to get more insights on China's property market in just a few minutes and hear why UBS is starting to change its view on the embattled sector. Plenty more to come on Daybreak Asia. This is Bloomberg. US officials say President Biden is seeking a response to the deadly attacks on US forces in Jordan that's tough enough on Iran and its proxies while avoiding a wider conflict. US Department of Defense Press Secretary Major General Patrick Ryder spoke with Bloomberg earlier.
We will take deliberate, appropriate action. Our focus here is not to broaden a conflict from the very beginning. We've been very focused on ensuring that the situation in Israel does not broaden into a wider regional conflict. Unfortunately, what you have here are Iranian proxy groups that are exploiting the situation and conducting these types of illegal attacks against forces that are in the region to actually preserve peace and stability. So again, we're going to do what we need to do to protect our forces while also cognizant of the fact that what we don't want is a wider regional conflict.
General, who were the perpetrators behind these attacks?
Yeah, so what we know right now is we are very confident that these attacks, this particular attack against this facility was by Iranian-backed proxies. We're working through the actual attribution piece right now, but of course it carries the signature of Kataib Hezbollah, which has conducted attacks in the past. But this is something that we continue to look at specifically.
And when you look at this, just for people following this and listening to what's been developing in the Middle East over the last month or so, how big is the difference between those groups and Iran themselves?
Well, for a long time, Iran has used proxy groups around the region to enable itself to have plausible deniability, enable itself to implement policy, and importantly, to essentially try to expel the United States and other countries that are at odds with its own policies and views from the region. And so this is, in a large part, what you are seeing in Iraq and Syria is that these proxies, and to a degree Iran, exploiting the situation, the tensions in the Middle East in an effort to try to expel the United States and the coalition from Iraq and Syria. And again, those forces, particularly in Iraq, are there at the invitation of the government of Iraq to assist in the lasting defeat of ISIS. That is the mission that we're there for, and that's what we continue to remain focused on.
Does Iran have plausible deniability this morning?
Look, we know that these groups are backed by Iran with the support of Iran. They organize, train, and equip these groups, and we will hold them accountable.
You will hold Iran accountable or these groups accountable? And I think, Major General, as you know, this is the issue. Which one is it?
Look, again, I'm not going to telegraph or forecast our response. We know that Iran is behind these groups. We're not seeking conflict with Iran. We don't seek war with Iran. But again, we will take necessary measures to protect our forces, and we will respond in a time and manner of our choosing.
That was the U.S. Department of Defense Press Secretary Major General Patrick Ryder speaking with Bloomberg's Jonathan Ferro. And we're seeing U.S. oil futures edge higher in Asian trading, with traders really awaiting the Biden administration's response to that deadly attack on its troops. But fresh news on steady output from OPEC Plus appears to have put the brakes on last week's rally. Bloomberg's Sue Keenan joins us from New York. And Sue, really seems to be a lot of question marks over the direction of oil from here.
Yeah, you just heard that the U.S. military is going to choose its timing on any response. So again, that really puts the oil market on edge, and traders continue in this waiting game to see which way the U.S. moves. White House officials again have said the U.S. is seeking a response that is measured. It has to be tough enough to deter Iran, but it has to be not so dramatic that it sparks direct warfare with Tehran. Markets were poised for correction, with West Texas Intermediate flashing signs of being overbought in the last two sessions. But the competing forces, the geopolitical risks versus the supply glut, really is what is causing a lot of the volatility here. West Texas Intermediate was up 7% this month, so it will end the month with a gain. But traders are concerned that not only could the U.S. response risk further escalation in a key area for global crude, but there's this overarching concern about ample supply, which is bearish on price. Fresh export figures show OPEC Plus output is robust and holding steady. That's why we saw West Texas Intermediate drop below 77 in New York trading before rebounding as Asia trading got underway. Again, Brent crude tending to move in a similar pattern. So technical forces right now, along with the oversupply issue, bearish, but a lot of traders are concerned about which way we may go given the overhang of this geopolitical risk.
Sue, meanwhile, we're hearing from the Petrobras CEO saying the Red Sea crisis could send oil above $90 a barrel. What's the thinking here?
Well, he told Bloomberg that if there is any escalation, that's where he sees oil prices going above 90 this year. Without escalation, he says it's a very different story. Now, you're looking at a Petrobras ship, which he says their group of ships fairly protected. They really don't use the Red Sea for their cargoes, but it does point out that this area is a very, quote, fragile neck for the oil and gas business. He says no one was paying attention to that for decades, but Yemen is on one side and Somalia on the other. Again, a very oil production-rich part of the globe. A separate attack last Friday on a fuel tanker in the Red Sea has just only added to concerns. Now, Petrobras says its ships have not been affected. It doesn't ship much oil through the Gulf, but oil prices could go above 90 if there's escalation. Without it, he says oil should continue trading between 70 and 90 this year. Again, Capital's John Kildup says, quote, none of the actors want a full-blown war. He thinks if tensions ease, prices drop.
Thanks very much. That was Bloomberg's Sue Keenan there from New York.
All right, got some breaking news on the Bloomberg at the moment. It is retail sales out of Australia for the month of December, and it's a pretty big miss, a contraction of 2.7%. We were expecting a contraction, just not that big. 1.7% was the analyst view, but a big reversal from the expansion that we saw in November. Does suggest that a lot of households front-loaded their holiday season shopping and then tightened the belt sharply in December to the tune of 2.7%. Seeing the Aussie dollar losing a little bit of ground here, currently just above 66 cents US. Well, let's take a look at how we're tracking in markets around the region. Meanwhile, we've got the Nikkei having another reasonably good day, better by 1/3% right now. And the ASX really knocking on the door of that record now. We're just 2 points away from the intraday record of 7,632, so 7,630 for the ASX at the moment, better by about 2/3%. The Kospi also is firmly in positive territory, better by 0.9%. And it's really IT stocks today, Bell, that are leading the gains.
Yeah, and also worth pointing out one big lagger that we've got in the session so far. This one's just come online in the last couple of minutes. Japan Aviation Electronics Industry. So what's happened is after the bell yesterday, it launched a tender offer for its own shares, pricing those at 2,605 yen each. The offer that it put forward is actually a 14% discount to Monday's closing price, according to our calculations here. The parent NEC of that company has agreed to the tender of around nearabouts 24 million shares, and so Japan Aviation are planning to spend nearly 70 billion yen on the tender offer. It's running until February 28th, so another few weeks to go. But that stock reaction you are seeing there is to Japan Aviation launching a tender offer for its own shares, and NEC as well cutting its stake. So it's actually the second time this week that we've seen NEC looking to shore up some further cash here. But let's move on to something else that was really plunging in the session yesterday, and that was China Evergrande shares, because we had the liquidation order in a Hong Kong court that cemented the downfall of a company that exemplified the country's real estate boom and bust. It's not clear, of course, at this point how the liquidation order could be implemented in mainland China. Bloomberg Economics says that if it does go ahead, it's going to be an additional blow to the confidence of Chinese investors and potential home buyers. It could also shatter any remaining hopes among creditors that the government will bail out distressed developers. Let's discuss the outlook now with John Lam. He's head of Hong Kong property and China research at UBS, joining us here in the studio this morning. So, John, I know that you can't talk about Evergrande specifically, but I am interested in what you think in terms of the sentiment. Is this going to be something that's negative for China's property sector, or is it possibly a positive because it just draws a line under the entire messy saga?
Sure. Thank you for having me today. So, first of all, I think this is likely to accelerate the debt restructuring for the other private developers. Because so far the other private developers are kind of delaying their restructuring process. But I guess with the latest news on Evergrande, the winding up order, this is likely to, the company have to accelerate the debt restructuring, because otherwise the bondholders will become impatient. I guess what is the implication here to the equities here is that because based on the announced restructuring program so far, there have been equity issuance or debt to equity conversion. So I would expect there will be quite a lot of equities being printed going forward.
And in terms of the other developers as well, do you think that the market is sort of wrong in focusing on the negatives here, or should they actually be looking at some of the positives? These are the companies that have managed to weather all of these issues in this credit cycle.
Yes, definitely, because we are talking about the sector is roughly about 10 trillion, 9 trillion RMB on the annual new home sales. So with most of the private listed developers going defaulted or restructuring the debt, so basically there are not much players being left, and therefore it's likely that the SOE developers are likely to dominate the market share.
What are your expectations around risks for investors in China's property developers more broadly if Beijing doesn't uphold the Hong Kong court's decision on Evergrande?
So I think the damage has been done to the offshore bond market because based on the bond price they're trading, so investors had a pretty low expectation already. And also given that over the past 1 or 2 years, the top authorities in China had been reiterating that the project completion is always the top priority. So I think the investor has a pretty low expectation already regarding on the winding up or restructuring process.
And where do you see property valuations heading in China now?
So there are two types of valuation. One is about the physical property price valuation. Another one is about the equity price valuation. So first of all, regarding on the equity price valuation, the equities has been falling 3 years in a row. So valuation have been at a multi-year low level. Even for the SOE developers, they are trading at 0.3 to 0.6 times price to book. So suggesting investors are very bearish on the sector. And then on the flip side is that if there's anything positive, such as market share gain or government easing support or the urban village renovation to support the property demand, that is likely to drive a massive outperformance here. On the property valuation, however, the property price from peak to now roughly corrected by about 20 to 25%. The valuation that we look at is about the rental yield. And right now the rental yield is roughly about 2% for Tier 1 cities, so which is still lower compared to the mortgage cost. So that's suggesting that people holding the property will have to expect further price appreciation because otherwise holding a property is a negative carry here.
I'm interested then of how you think that those large developers, and you're saying that the SOEs could be the big winners out of this, how do they actually need to pivot their company strategies then?
Sure. So two things here. Number one is to reduce the land bank size, going to the primary location because of the reduced competition. So instead of going to the lower tier cities, right now they go to Tier 1 cities or Tier 2 cities. Within the cities, they also go to the more prime location because of limited competition. And second thing is that they are also, some of them also transitioning to do the commercial property investment, like a landlord. So going forward, there will be two earning stream, one coming from the property sales, another coming from the rental income.
What do you think about the property measures that we've seen so far? Because we have seen Beijing and other cities as well, of course, really trying to stoke demand from consumers in the market. It hasn't really had much of an impact so far. What would be something that shifts that?
Sure. Over the past 1 or 2 years, the Chinese government have been trying to stimulate the household sector by removing all the restrictive measures. But so far, the impact has been pretty limited. Or not useful or effective. And the major reason is because the household sector has been suffering from the income job losses or uncertainty about the income expectation. So what is really needed to stimulate the demand back to the market here is probably coming from the central government. This is also the reason why we are turning more positive regarding on the recently announced program, which is the urban village renovation and also the social housing. These two are basically the central government adding leverage to take up some of the excess inventory from the market.
All right, thanks so much for your time this morning. That was John Lam, head of Hong Kong and China property research at UBS. And we'll have more coming up on Evergrande's rise and fall, of course, and China's beleaguered housing sector when we speak with Charles Cheng of S&P Global Ratings. That's later on Bloomberg Markets Asia. And we'll have more ahead on Daybreak Asia. This is Bloomberg.
Malaysia gets a new king on Wednesday when the 65-year-old billionaire Sultan of Johor, Ibrahim Iskandar, officially takes over. The role's traditionally been largely ceremonial, but in recent years the monarch has played a bigger part in determining who takes political power. For more, let's bring in Bloomberg senior editor Tom Redmond. So Tom, tell us a little bit more about the Sultan of Johor.
Hi. So Johor is the southernmost state of Malaysia. It's Malaysia's second most populous state. It's in a very strategic location right next to Singapore, just across the causeway, and it's ruled by the Sultan of Johor, Sultan Ibrahim. Now, in Malaysia, it is a very unique constitutional monarchy in which nine hereditary rulers of nine Malay states with hereditary rulers take turns to be the king of Malaysia. They rotate for 5-year terms, and next up is Sultan Ibrahim of Johor, and he's a very colourful character.
Yeah, colourful, and also someone who hasn't been perhaps shying away from displaying some of his wealth as well. So what exactly do we know about his financial position?
Yes, so one of the things we did in our story was attempt to estimate Sultan Ibrahim's wealth, so what we found out was, looking at the wealth of his own wealth and his family's wealth, and looking particularly at the assets that are easy to calculate the net worth for, we worked out that he's worth at least $5.7 billion US. But that is, that's just the surface, and there's probably a lot more wealth there. He's probably worth a whole lot more than that, and he's definitely one of the richest people in Malaysia.
So he's certainly rich, and he's about to become more powerful as well. Can you tell us a bit more about that?
Yes. So as you mentioned earlier, the king in Malaysia is a mostly ceremonial role. However, in the past few years, you could trace it back maybe to 2018, when the coalition that ruled Malaysia for basically 6 decades since it gained independence was ousted, and it created a bit of a political vacuum. And what's happening more and more is governments are collapsing, or, for example, in the last general election, November 2022, resulted in the country's first ever hung parliament. Now, one of the powers that the king does have that isn't ceremonial is the king can step in to choose a prime minister in situations like that. If an election is inconclusive or if a government collapses. So the current king has actually done that 3 times. So Sultan Ibrahim, as he comes into the job, has a lot more power.
All right, that was Bloomberg senior editor Tom Redmond, and you can read more on this story in today's Big Take on the Bloomberg terminal, or online, of course, at Bloomberg.com. Here are some of the other geopolitical stories we're continuing to track around the world today. Qatar says negotiations to free hostages taken by Hamas during its October attack on Israel are making progress. Prime Minister Sheikh Mohammed Al Thani says talks are moving to a place which could lead to a potential permanent ceasefire. Qatar is the key mediator in talks between Israel and Hamas.
Right now, I will describe it, the progress that we are making in the last couple of weeks is we are in a much better place than where we were a few weeks ago.
We've learned Russia is considering an indefinite suspension of wartime capital controls. The measures are aimed at easing pressure on the ruble after international sanctions over Russia's war in Ukraine. The restrictions require exporters, including oil producers, to repatriate 80% of their overseas earnings. 90% of that must be sold for rubles. You can watch us live and see our past interviews on our interactive TV function at TV Go. There you can also dive into any of the securities or Bloomberg functions we talk about, plus become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go. This is Daybreak Asia, just bringing you some breaking news crossing the terminal right now. China's 10-year bond yield falling to the lowest level since 2002. That is, of course, a more than 2-decade low. What's really been driving that is this expectation that we're going to have to see some sort of monetary easing after the central bank took steps to loosen liquidity. So that yield there, you can see it slipped back to 2.485%, a level, as we said, unseen since 2002. What's really clear out of all of this, Paul, is that China's economy remains extremely fragile here. We had the liquidation order for Evergrande yesterday really capturing the headlines, but the weakness in the Chinese economy is continuing to persist. There is that property market rout. There's other issues at play as well, more of those structural ones that we continue to talk about. But certainly there is that call for policymakers to deploy more stimulus in order to try and shore up growth. And one of the moves that we had toward that end was last week, the PBOC pushing through that RRR cut set to take effect in just a couple of days.
Well, let's take a look now at some of the corporate headlines we're tracking around the world. Brazilian mining giant Vale has reported a bigger than expected increase in fourth quarter iron ore production. The world's second largest supplier of the commodity delivered more than 89 million metric tons last quarter. The average estimate among analysts was for 83 million. Vale's output may undermine prices, which have been resilient despite China's slowdown. Elon Musk says the first human has received a Neuralink brain implant. In a post on X, Musk says the patient is recovering well, with initial results showing what he calls promising neuron spike detection. The startup aims to create a computer-brain interface that will initially enable people with paralysis to control external devices with their thoughts. It's raised more than $500 million in venture capital since 2016. IBM has told US managers still working remotely that they must move closer to an office by August or leave the company. A memo sent earlier this month says all managers must now report to an office or a client location at least 3 days a week. IBM has closed several US offices since the pandemic began, potentially complicating return to office plans for workers. Renault has scrapped plans to list its electric vehicle business Ampere due to a lack of appetite for share sales amid a slowdown in demand. It was seeking a valuation of about $8.7 billion for the business, which is almost as much as Renault's own market value. The performance of EV-related listings fell about 35% over the past 12 months. Bell.
Paul, just recapping again that headline that crossed just in the last couple of minutes, that's China's 10-year bond yield falling to the lowest level we've seen since 2002. That really tells us just how much concern there is still around China's economy, the health of that major economy, and the push that's really coming down to policymakers now to push through further easing. It's interesting because overnight we had the S&P 500 hitting a fresh record high, closing above 4,900, that mark. But at the same time, that optimism is certainly not translating across to what we're seeing in Chinese futures so far, dropping here. You can see ahead of the open in about half an hour's time, down 0.5%. So clearly something we're going to be tracking here. And one of the reasons that we've really seen investors in China really turning to or looking for alternative assets outside of Chinese equities, because that appetite is continuing to run high. Investors are clearly burned by years of underperformance in local stocks, and that is as well fueled huge price distortions in funds that are tracking these assets. So let's get more now with our Bloomberg Intelligence ETF analyst, Rebecca Sin. What exactly is happening at the moment? Because there has been a big focus on those ETFs that are tracking Japanese assets in mainland China.
So I think to your point, Chinese equities, investors have been burned on that. It hasn't performed. And investors are searching for yield elsewhere. They're going to USA, they're going to S&P 500, they're going to NASDAQ. It's at an all-time high. They're going to Japan. We've seen the Nikkei return almost 30% last year. And so investors are really trying to go away from their Chinese route, sell their Chinese equities, and go into alternative asset class elsewhere. The problem that this has led is that a lot of the fund houses have a quota in terms of how much they can invest overseas. And this quota is now coming to their peak. And as a result of that, mutual funds, ETFs, are reaching this level, and they can no longer trade. So what this means is that you can no longer buy into this ETF. ETF. And so as a result of this, some of these ETFs have started to trade at a premium. So for instance, eFunds MSCI USA 50 traded at a 43% premium last week. And whenever the ETF trades at a premium of more than 10%, the CSRC will put out a warning to investors. So some of these funds have had almost 12 warnings in the past week. So this is a huge amount. And ultimately, this warning is a caution to investors to be careful. Take note that these ETFs are trading at a premium.
So given those warnings that have come through and sort of the market dynamics and rules around it, do you think we can expect the trend to continue at all, or will it be stopped in its tracks by that?
So I think this trend is going to continue because ultimately people don't have faith in the Chinese economy right now. People are fleeing and they're looking for places to put their money elsewhere. And USA has done phenomenally well. Japan has done phenomenally well. And so we could expect more and more people trying to diversify their assets. And so one of the things that's going to happen is we could see more ETFs either being halted or having their creation halted, whereby you can't buy into this ETF. But I think some of the things that may alleviate this is, for instance, some of the ETF issuers may issue other ETFs. So, for instance, China Universal is going to be listing an MSCI USA 50 ETF in the coming weeks. And because it's a new ETF, they may not have that quota problem that some of the current ETF issuers have. And so I think that we could see more halting coming. We could see more warnings coming for sure. The premium does trade at a discount or a premium, and it does vary based on market conditions. And so it's not abnormal for an ETF to trade at a premium or discount. We've seen this in Bitcoin, for instance, when the Grayscale was trading and they had their creation halted. The ETF was trading at a 52% premium, I think, at one point. So it is fairly normal for this to happen. But I could see more and more ETFs, especially in mainland China, the ones that do have a QD quota associated with it, being halted.
So besides the potential for more halting, what else could possibly happen in the ETF space in China?
I think one of the things that could happen also is that we could see other ETF issuers launch more products with foreign underlyings, because there clearly is demand for it at the moment. There's currently only 32 ETFs that have a QD associated with it. And so, for instance, China Universal has already filed for an ETF tracking the MSCI USA. And so we could potentially see more ETF issuers launch new products associated with this. But one of the things to be cautioned on is whether the CSRC will approve it. Ultimately, they would like to keep the money onshore, and they would like to see investors invest into the domestic market. And so that's why we've seen the support of the national team invest into the CSI 300. So this year we've already seen a lot of inflows into CSI 300. And that's the CSRC really telling investors that, look, we're here to support the market. You don't need to go to other underlyings. You don't need to go to invest in the USA or in Japan. You can invest locally, domestic, in this market. And so I think it'll be interesting to see what the CSRC does in the coming weeks. But we could see more halting coming and more new products that are launched with foreign underlyings.
All right, Bloomberg Intelligence ETF analyst Rebecca Sin there. Now for a look at some of the stocks to watch when the market open gets underway in Hong Kong and mainland China. Keep an eye on BYD and peers after the company reported earnings that rose due to soaring EV sales, but still fell short of analyst expectations. Property shares, of course, also in focus as the nation's top economic official calls on city authorities to follow through on easing measures for the housing market. And of course, we'll be watching Evergrande Property Services as it resumes trading in Hong Kong today. Evergrande NEV, meanwhile, has also applied to resume trading. Here's a quick look at how markets are positioned right now. Of course, we are watching the ASX just about 10 points shy of that intraday high. That is it from Daybreak Asia. Markets coverage continues at the start of Hong Kong, Shanghai and Shenzhen next.